Welcome to my video library. My name is Phil Grande of philsgang.com. Welcome all students, all gang members or non-gang members. To join the gang, just go to philsgang.com. Okay. Recently, we had a move in gold. Why? What is going on? Well, it has to do with the dollar. So I'm going to explain to you how the dollar and the bond, how it relates to a move in gold. So this way, you'll have confidence in buying gold or gold mining stocks. In fact, gold mining stocks are leading gold. Let's begin with the dollar. The dollar has been giving us tremendous strength. Been going straight up. But when the dollar goes up, it suppresses gold. And it suppresses oil. Also, which people don't really know, it also is supposed to suppress stocks, believe it or not. But stocks aren't being suppressed because, remember, stocks are a dollar-denominated asset, and we have a lot of money that's coming in from Europe that is buying stocks. So we have the dollar is increasing in value every day because of the cheerleading, how we're going to be, our economy is doing terrific. We're going to be raising rates in June, and all that cheerleading, people are dumping euros and buying dollars. And with those dollars, they're buying stocks. If that wasn't the case, then the dollar would be going, the stocks would be going down. So let's just, for the moment, let's just deal with dollar going up, gold going down, and we also have the, of course, the gold going down, and we have oil going down. So what we've got to think about is the dollar is very important because the dollar, with the dollar, the strength in the dollar, everything happens. From that dollar. Let me explain, especially how it relates to gold. You have China. So we'll put up here China. Now China, what they do is they have a printing machine and they print all their wands. Okay, there's their wands. And with those wands, they go over here and they buy the dollar. Now, they don't take the dollar and put them in a safety deposit box and let them sit there. They want to take these dollars and get some interest on it. So they look to the United States because the Treasury, and here's their Treasury, a little building here. There's the Treasury. Okay, and the Treasury Department, okay, they collect all our revenues and they have a checkbook, and here's their checkbook. It's open. The problem is there's no money in the checkbook. Zero. No money in the checkbook. Maybe 50 cents. And however, we got bills to pay because Congress spends money. So much money. We got 18 trillion in national debt. And each day we have a deficit of 6 billion, meaning we spend 6 billion more than revenues we take in. On the 18 trillion, we have to pay an interest only 222 billion a year in interest, a year. And of course, we borrow money and we pay an interest on the deficit. But for the sake of argument, let's add the deficit to the 18 trillion. All right. So what China does, knowing we have all this debt and we never have any money because we spend more money than we take in, they see an opportunity to make money. So they take and they come down here and they say, look, what if we give you our dollars? So they take the dollars, give them the Treasury, and in return, they want interest. So what they do is give them a bond or Treasury. Let's just do a white piece of paper right here. So this is a T-bill, and let's say the interest on it is 4%, the yield. So they're happy. So what they're doing is they're printing their yuan, buying the dollar, coming over to the Treasury, saying, I'll put this in your checking account, these dollars for you, and what I want in return is interest, and then give me a note, and they do, and they got now they have a Treasury, and they're collecting 4% interest until this thing is due and paid off. So they're happy. They're happy. Now the government's happy because They're raising money, or what you heard the term selling debt. So that makes the dollar, that gives demand right here. The dollar is in demand. Okay, there it is. The dollar is in demand. Why? Well, because you got China who wants interest, and of course the more they buy the dollar, the more they give their dollars to the treasury so they pay their bills and they collect interest. They're happy. So the demand keeps going up because now the Saudis want to do the same thing with all their money. So now you got the Saudis. We'll put them in blue. And here's the Saudis, okay, right here. And they are doing the same thing. There's the Saudis. Same exact thing, okay? They're doing the same thing. They join and they do the same thing. Well, let's do it separate so we don't get confused. And now they got a treasury over here. And they're collecting. So they're going to get their interest of 4%. And it will be paid off at a later date, okay, down the road. Now all of a sudden, though, the government says, you know, I'd like to pay this debt off with cheaper money instead of paying 4%. So now the Fed, they get involved. So the Fed does the same thing. So the Fed, they print money, okay, and the same thing. So they, just like the Saudis, like they print money, and all this money, they go over and make a deal with Treasury, put it in their checking account. So all this money is going down into the checkbook here. See, it's all going down this little checkbook so they can pay their bills. But the Fed says, you know what I'm going to do? I want to get this rate down. So I'm going to step in front of the Saudis and the Chinese, and I'm going to really ramp up the printing. So now they roll out their printing machine right here, little wheels, big bar, and here's their handle, and they're going to really print the hell out of this money. $45 billion a month. So by doing $45 billion, that's called the Fed doing quantitative easing. So what they do is print money, boatloads of money. So they come over here and they put a lot of money in the Treasury, and the more bond treasuries, they buy 10 times the treasuries that China Saudi does. And when you buy treasuries, the yields or interest starts to drop. So now it dropped. They bought so much, it drops from 4% to 1.9. So now the Saudis and the Chinese come over, they look, they go, whoa, what happened to the yields, to the interest? That is unattractive. Well, the Fed had a little trick going here. They wanted to be unattractive. First, they wanted the yields to be low or interest rates to drop because now they're paying back this debt with cheaper dollars at 1.9% instead of 4%. But there's another trick to it. The reason that they knew the Chinese and the Saudis would say, hey, this is unattractive. I'm not going to buy treasuries. So they go, well, I'm not going to go back home with the money, so I think what I'm going to do is I'm going to go and I'm going to come over here and shift instead of treasuries. I am going to buy stocks. So it forces them into the stock market. And that's what happened. So this 1.9%, they said, no, thank you. And the Chinese and Saudis, and all of a sudden the market shoots up without companies having good earnings, without a good economy. And that's why the Fed did it, so that they could buy all these treasuries to drop the yield, to make it unattractive, to force the Saudis and Chinese into the stock market, shift them away from the treasury into the stock market, because the economy's so bad, these companies, their stocks will not go up. So this also makes the companies very happy, because now their stocks are going up without top-line sales, without margins. They're delighted. Their stock is going up. Now they say, well, I'll tell you what we'll do with these companies. Here's the Fed. With QE, we'll print even more money. So here's the printing machine, and they're printing piles of this money, okay? All under QE. So now the Fed says to the corporations, okay, and here's the corporations over here. We'll just say C, RP. There's the corp. They say, look, the economy's bad. Jobs are or we don't have good paying jobs. People aren't saving. They're not spending money. So your stock's not going up. So what we'll do is print all this extra money and we'll lend it to you, the corporations, at zero. Zero interest. What a hell of a deal that is. And the corporations bought over $1 trillion, borrowed $1 trillion at a zero interest, and they went and bought their own stock. Yep, there goes the stock market going up, buying their own stock. So the market's being pushed up by the Saudis, the Chinese. At first, we're pushing all this money, helping with pay the debt, and giving dollars to Congress to go spend. But they got stopped because the Fed came up and said, these rates are too high. Let's get them down low. We'll buy more of this stuff than they will, dropping the yields down, interest rates, so we can pay this national debt off and our deficits with lower dollars, lower interest rate dollars. Then they said, hey, because the economy's doing terrible, people aren't spending money, stocks aren't going up, we're going to create a lie. We're going to say that QE, the purpose for QE is to get a fast recovery. And that's not the truth. It was a lie. It had nothing to do with recovery. What it had to do was to mask, they could mask this terrible economy. So here's the economy right here. Okay, terrible economy. So what they decided to do is mask it, put a big mask over it so nobody could see it. And they masked it by pushing the stock market up because people really think the market and the economy is the same thing. So all of this money, all this QE was for the purpose of dropping their interest rates so the government can pay cheaper dollars on their debt, to print money for corporations, to push up the stock prices. And we've been going along since 2009, and our market's up 220%. Okay, so our market's up 120%, all on this with no earnings. Can you imagine that? But what does this do to the dollar? Going back to the dollar, it makes the dollar strong. Why? Because look at all the reasons that we're printing money. It's called demand. So the dollar keeps going up. And the more that dollar keeps going up, the Fed is happy because it suppresses gold. Because remember, they're not in the business of gold. The Fed's in the business of money. And so they're happy and it suppresses gold. So how does gold turn around like we saw in the last few weeks and all of a sudden start to go up? Well, there's one other thing that was going on that created demand for the dollar, and it's called, right over here, we'll call it jibber jabber. Okay, so it's all jibber jabber. Okay, jibber jabber. Okay, and what's jibber jabber? That's all the talking heads saying, wow, the economy is really good. Look at the stock market. Wow. And look at the earnings. Well, what are the earnings coming from? They're cutting everything. They're cutting all the overhead, firing everybody. So with all the jibber jabber that the economy is good, now Yellen gets in and she joins the jibber jabber. Yellen, here's Yellen. She joins and says, you know, the economy is so good. Of course, they're lying. It's so good. Yellen's saying, we're going to raise rates. We're going to raise the rates because to prove how confident we are that the economy is doing so well, we're raising rates. Wow. Now that people in Europe, here's Europe over here. Okay, a little continent here. Here's Europe. They have euros. Over here's their euro. They dump their euros and they buy dollars. Now you got more demand going into the dollar. Look at this. Dollar just keeps going up and up. And the stock market's going up and up. Wow. But it's all this is considered a what? A bubble. Because this is a bubble. Because what makes a market? Okay, not this phony pumping money in through forcing the Saudis and the Chinese out of buying bonds and shifting them into the stock market, and you don't have good markets when you're printing money to give to corporations so they buy their own shares. You don't have a good market just because you do all this jibber jabber and lying how the economy's good and the interest rates are going up so that the Europeans dump their dollars here and dump their euros and they come over here and buy and buy these dollars, but it's creating a great demand. So you have to believe in the story. And as long as you believe in the story, the economy's getting better and the cheerleading goes on, the dollar keeps going up and everything's fine. But all of a sudden last week we had a problem. All of a sudden we started to see that gold started to go up. Well, how come gold was going up on January 1st or 2nd and 3rd? Gold was going up. And gold was going up when the dollar was still going up. That doesn't make sense. Gold going up with the dollar going up. Gold goes down, the dollar goes up. Well, because all of a sudden last week we had the earnings report, and everybody's saying what a terrific economy we got. We're producing all these jobs, but come to find out wages, right here, wages, right? It's really sucked. As a matter of fact, the wages are so bad, they cut in half their wage expectation in November. They said wages increased by 0.4. Well, they cut it in half. They found out it wasn't. It was really 0.2. So with the wages, this dollar started to weaken for the first time. And then we saw what happened to gold. Really started to shoot up almost 18%. Because all of a sudden now there's a question mark. Is this economy as good as they say it is? And people are finding out when they get down into the different metrics, no. And the wages was the tip-off. So how long can they keep this jibber-jabber going? And how long can they keep buying this, the Fed buying the treasuries to drop this rate down to 1.9%? Well, we've just found out, right, a month ago, they said to get this dollar up and to lie even more to say the economy is good. They're saying the economy is so good, we're no longer doing QE. We're no longer doing QE. So they said, wow, you're not doing QE? No. So they take QE. They say, well, we're not going to do QE anymore. Well, if we're not going to do QE anymore, then who's going to, we're buying all the bonds to drop the yields, to pay the debt with cheap money, and to drop the yields to force China and the Saudis to go into the stock market. So if the U.S. is not doing quantitative easing and not printing the money to buy all these bonds to make the market move up, who's going to do it? Again, Europe. As long as we can convince the people overseas in Europe the economy is good, they're coming over and they're buying the treasuries. They're still buying the treasuries. They're still buying the debt to keep the interest yield down to 1.9%. So you got all these people in Europe believe that jibber-jabber, believe Yellen, the dollar's going up, so they're dumping euros to come in, and they're buying they're buying stocks, remember, as well. But as long as they continue to buy treasuries and keep yields down, market will go up. But all of a sudden last week, again, remember we had a crack. Here's the crack. We had a crack in this, in the theory that everything's doing well. And all of a sudden people started to remember, they started to run to bonds last week. Everybody was buying bonds last week, dropping yield even further. So what does this have to, can gold keep going up? Yes. Because this is for the first time we saw gold going up when you have oil going down. We haven't seen that in a long time. Gold going up, oil going down, gold going up when the dollar was going up. But now we see the dollar cracking, rolling over, and gold is going up further. So is this it? Have we finally turned the corner with gold? Yes. Unless they bring in what? QE4. And that's what I think is going to happen. I think they're going to start all over again where the Fed comes in, prints all this money, buys all the treasury, drops the yield down. Because remember, they're out of the business of QE right now. They're depending on Europe to believe the story that our economy is getting better, we're raising rates. They're coming over here and buying the treasuries so that they still can pay their debt back with low dollars. But soon as Europe doesn't believe it anymore, that there's a bunch of BS, the economy in the United States is not as good, then they're going to have to come in and do QE. And we're seeing that in the gold going up. The gold going up is telling us Europe is not believing the story, other countries aren't believing the story, people in the United States aren't quite believing the story anymore, not like they did a month ago. Now, how do we know that on a stock chart, and why I use my PT2? Because on a stock chart, if you look, the stock market was going up like this. When the stock market goes up like this and you only get little pullbacks, 1.5%, that means the institutions who buy stocks are very confident which way the market's going to go, the direction. But in the last month, it's been doing this, 200 up, 200 down, 200 up, 200 down. Okay, back down again. What's this mean when it falls apart? There's no more confidence by the big institutions that they no confidence in which way the market's going to go. And with the dollar cracking last week and people buying bonds last week, shooting out of the stock market, this is what we're getting. So as long as the market keeps giving us big swings, the dollar should keep on falling apart, gold keeps going up, and if they really give up and they say, you guys have been lying to us, the economy's not good, then QE4 will have to come in, and that's what I think is going to happen because we've been lied to about the economy. And that's why you use charts. Because of my PT1 chart, I could find out. I knew in advance what the market was doing, and that's a key player in all of this right here. And that's why you buy, or that's why I use the QE2, and you should, I mean the PT2, and you should as well. Okay, hope this helps you understand. See you on the charts.